Hi,
I
this
supposed to
is
show something on the
Archana
screen
from
or
Archana
just
Trades.
talk?
Huh? I'll start and then I'll tell you. Here is Rajaram.
Okay, go for it.
Okay. So, hi, this is Archana from Archana Trades. Today is 2/3, 2022. Facebook had a major gap down on earnings. So let's do analysis for Amazon. Um, I am here joined by Rajaram, who is a wealth manager. He is going to do fundamental analysis on Amazon and then we'll go over technically with it. Raja, here.
So this is going to be a little bit more of macro analysis based on their last quarter guidance and the expectations for this quarter. So thank you, Archana. Again, it's always a pleasure working with you. So last quarter during the earnings call, Amazon guided down substantially. They guided net sales of 130 to 140 billion, while the street was expecting 142 billion at that time. So their top end was lower than the street expectation. They also called out a 60 basis points impact from foreign exchange rates. They called for an operating income of 0 to 3 billion. Going to the current consensus now, the expectation on the street is for 137.6 billion net sales with an operating income of 2.4 billion. That is $3.58 a share. The street is expecting 36% growth in AWS to 17.4 billion and a 30% advertising growth to 9.3 billion. Just highlighting those two because those are the biggest growth areas for Amazon. So we'll look at both the bull case and the bear case here, and I will explain what I think from a macro and a fundamental perspective. The bull case is Amazon's spend cycle is long in the tooth already. It's been over a year that they are in a heavy spend cycle. And going by previous history, it should have either ended last quarter or is in the process of ending very soon. They've lowered expectations already. They should be able to beat on AWS and advertising. Both we saw that both from Google and Microsoft results, which handily beat in those areas. So I expect Amazon also to be able to come in better than street expectations there. From an e-commerce perspective, the consumer has not materially slowed down. We are seeing that in strong consumer numbers from the economic data we've had in the last 3 months since Amazon results. Also, retail earnings coming out, even the ones today, have been very strong, especially at the higher end. They are doing very well, and overall retail earnings and guidance continues to be bullish. So that's the positive side. On the negative side, obviously Amazon called out supply chain last time. Supply chain was improving right into their guidance time in early Q4, and until late Q4 things were actually looking better, and then Omicron hit China, and China has been in this on again off again spree of shutting down cities, ports one after the other. It's not persisted, but it's been going around and it's been highly disruptive. It is still going on, plus with Olympics coming up, that problem could just get worse. But that's another story for the next quarter, right? So the other part that is negative is inflation, material cost. They called out steel costs, which was very surprising to anybody that listened to the call. Steel prices are still up from last quarter when they called it out, so that's not a positive. Most material costs, construction costs, are actually up a little bit, so that's not a positive. And the last one is US dollar. US dollar has gained strength. Yesterday in Facebook call, they called out currency as causing a 200 basis point hit to their growth. So this could be a real problem for Amazon. So taking those positives and negatives, my guess is that earnings are going to come in either at the top end of their guidance or it's going to beat a little bit. But where I see the biggest positive for Amazon is the guidance. I expect them to guide up substantially, and I think that primarily will be driven by end of their spend cycle, and I think that is going to be the floor on the stock. This is my assessment based on everything I've read and everything I've followed from analysts. Back to you, Archana.
So let's go ahead and do some technicals. Amazon did not do much last entire year, right? It has been between this 3,000 and 3,500 to 3,700 just going. But if you look at this is head and shoulders. This is the shoulder, head, shoulder. If the neckline breaks, which it already has, then the measured move comes to around this 2050, right? Which is also the 78.6 retracement of this entire 2020 March lows move to this 3,700. So that is one thing that is there. So 2050 I don't see breaking. That is also the September 2018 highs. Then you're looking at a trend line coming all the way from 2016 that also comes at around this anywhere between 2200 to, if it falls. Like, why am I going all this place? Because Facebook had 3 standard deviation move. So the expected move for Amazon right now is $250. Okay, so $250, and you're talking about 3 standard deviation, which means you're talking about say 700, 750 points. That means this 2050 should be safe. Anywhere between this 2200 to 2050 should be easily safe. And then what I'm looking at, this 200-day moving average, 200 week is at around 2450. So that's where I am looking to buy after hours if it goes down. That's my plan. But let's look at what the option flow is saying. The option flow, there were some June 1,000 contracts came in for 3,500, 4,500 calls were bought. So that's going to be over here all the way. Yeah, over here. I'll show it over here. So that 1,000 over here, I will have to go ahead and look at this. Yeah. Now there are many more things that have come in, but yes, 1,000 contract for June, 3,500 to 4,500 came in. Okay, RTX keeps going higher. I'm long that anyways. So that's one. My plan is just to sit, not do anything. After hours, probably pick up over here if it falls. But 2050 seems safe. Rajaram and I, we were thinking of doing selling a put, right? 2,100 put in September to buy, or June actually, and buy 3,500 for 4,000. That was coming to almost break even. It's too much of capital, so rethinking, not yet thought about what to do. What do you think, Rajaram? You still want to do that?
You know what, with all these 2 years of YOLO trades from people on crazy companies, at least we've got, this on a good company. It's gone nowhere for 2 years, and I have a very strong conviction that irrespective of results, the guidance is going to be stronger this time. The results might be so-so, but I I don't think they are going to disappoint on guidance. So this company always turns on guidance, and all it takes is they have incredible control over spend, and if they pull back spend, the profit shoots up, and that's the entirety of or the simplicity of the case, right? So I think we should go for it, right? It's
Okay.
if you saw the size of that trade that you showed me, you're
Yeah.
not fooling around.
That is there. We saw that. I was just thinking, why not just do 2100, 2060? You still get almost $4.5, $5 for that. At least it doesn't hold up a lot of margin. Yeah, so this is the trade here, 3500 to 4500. 1,000 contracts came in, and they paid $47 for it. So that is what we are contemplating. That is, it has one more earning cycle, so you have the time actually to go for that trade. So the better trade is to just sell something at 2100, 2060, get $5 for it, and if the earnings reaction is good, we can always get back into call spreads. Makes sense, right? That is a better trade than just buying right now.
It's the smarter trade, yes, agreed.
Okay, so that's our plan. Let's see what happens at 3 o'clock after market.